The code also imposes 3 further limitations on the risk of losses for partners from their partnership interests. The first is at-risk limitations. This is going to touch on the non-recourse liability. So partners are allowed to recognize loss only to the extent it does not exceed their at-risk basis. And their at-risk basis is going to equal to the normal partnership basis, except it's only going to include liabilities when the partner is at risk for that amount. So the at-risk basis will not include non-recourse liabilities because the partners are generally not at risk for that. There is going to be an exception. This rule is not going to apply to non-recourse qualified real estate financing debt when the following conditions are met. The financing is secured by real estate used in the partnership's real estate activity. The debt is not convertible to any kind of equity interest in the partnership, and the financing is from a qualified person or from any federal, state, or local government or is guaranteed by the same. Unrelated persons must do the lending. So we can't have related party lending here. The next set of limitations is the passive activity limitations. This is something that you studied in your individual income tax course. We know that individuals are limited in their deduction for passive activity losses to their income from the passive activities. And a partner who owns a limited partnership interest is generally considered to own a passive activity. So the test is material participation. We're not going to dive into the specifics of this because you've already learned it in your individual income tax. But this is something the losses are going to flow through and then they're going to be dealt with on the individual return. If the investment in the partnership is a passive activity, those losses are going to be limited to income from a passive activity. Any disallowed losses are going to be carried forward. This is not going to have an effect on the partner's basis in the partnership. It's going to flow through and then the losses are going to be carried forward until the partner can use the losses. And then finally, we have an excess business loss deduction prevention. It limits excess business losses from being deducted, and excess business losses are defined as the excess of the aggregate deductions for the year attributable to trades or businesses over the sum of the aggregate income or gain attributable to such trade or businesses plus $250,000 or $500,000 for a married filing jointly taxpayer. Any amounts limited by this rule are going to be carried over as a net operating loss subject to the 80% taxable income limitation. And this should say it applies at the partner level after taking into account passive activity limitations. Finally, there are also some limitations on partner transactions with the partnership. So if a partner sells a property to the partnership or vice versa, no loss can be deducted on the sale or exchange between a partnership and a person who directly or indirectly owns more than half of the partnership's capital or profits interest. Losses are also disallowed on sales or exchanges of property between two partnerships where the same person owns directly or indirectly more than half of the capital and profits interest. Gain will be ordinary in a sale of property between a partnership and a person who owns a controlling interest, not capital. This rule is only going to apply, though, when the property that's sold or exchanged at a profit is not a capital asset in the transferee's hands. Also, guaranteed payments often occur in a partnership, and that's when a partner, let me back up, shareholders can be employees of corporations, but partnerships generally cannot be employees, cannot employ their partners. So a partner is not an employee of his partnership, and most fringe benefits are going to be taxable to the partner, where they wouldn't be to a shareholder. Partners who perform services for their partnership are compensated for these through the use of guaranteed payments. They include more than just salary. Guaranteed payments can also be made for the use of invested capital that are similar to interest. Like salary and interest income, guaranteed payments are always ordinary income to the recipient. They're not capital. The guaranteed payment is included in the recipient's tax year during which the partnership tax year ends, and the partnership deducts or capitalizes the payments. And then for the partnership, the payment is going to be treated like it were made to an outsider. And if the service is of a nature that must be capitalized, the guarantee payment would be capitalized. Otherwise, it would be a deductible ordinary expense. In a family partnership, often partnerships are used between family members for tax planning. So it can be used to reduce current rates of tax, and it could also be used for estate planning. But as you know, the IRS is leery of these things, so the IRS imposes limits. So family partnerships allow income from an investment to be spread among family members having lower marginal tax rates. The question of whether a family member is actually a partner is an issue that is frequently litigated. These three tests must be met if a family member is to be considered the owner of a capital interest in a family partnership. 1, the partnership interest must be a capital interest. We know capital versus partnership interest. We know what that means. Capital must be a material income producing factor in the partnership's business activity. So it can't just be a service business. There has to be investment that is a material income producing factor. And 3, the family member must be the true owner of the interest. And that's really a facts and circumstances test, and it's heavily litigated. A lot of it depends on how the family member acquired the interest. If the family member bought the interest, it's pretty clear that it's a true owner. But if the family member was gifted the interest, it's a lot harder to make that case. And then if the family member is a minor, it's going to be even harder. And also donor-donee, I should say donee, not done. Donor-donee allocations are heavily scrutinized. The partnership income must be properly allocated between a donor and a donee in order to be accepted by the IRS. And the donor must be allocated reasonable compensation for services rendered to the partnership. Any remaining income must be allocated based on relative capital interest. So in this family partnership, there's less wiggle room in how to allocate things.